So yes, so till here we did yesterday, right? Till this clearinghouse. Now module 39.2, position and leverage. Long position and short position. Okay, hedgers. Uh, long position means basically you are bullish on the underlying asset. Okay. And here short position is you believe that the price will come down. Generally, that is the okay. Hedgers, these are all derivative topics again. I'll come to short selling. Okay. Now, short sales and positions. So, short selling, any idea what is short selling, Shravani? Hello?
Yes, sir.
Yeah, any idea what is short selling? No idea. Hello? Hello, can you hear me?
I could be wrong, but isn't it where you buy from a broker, um, and then you sell them at a lower price and then return it to the broker, making a profit?
Okay, I couldn't hear you properly actually. But anyways, I'll just explain it now. See, short selling, first of all, short selling. Okay. Now, see, there is a video also on this one, short selling. Separately, I have made that video. 1 second, I'll just send that video before I forget to it. Plus, I will be anyways explaining now as well, but you can watch that as well. Okay. Yeah. Okay. See, short selling. Normally, you know, in business, what do we understand? We think that we have to buy first, and then we have to sell. This is our understanding, that we have to buy first and then we have to sell. I'm not even speaking about all this share market, all those things. Normal business. We have to buy first and then we have to sell. But then, is it the case always? Not necessary. There are many businesses where selling happens first and then buying happens next. Is it? What could be those examples? Think like you are ordering for your book in Flipkart or Amazon. Now, when you are ordering and you are making the payment, what has Amazon done? Amazon has sold books to you, but then Amazon might not have any books also with them. Then how are they managing to sell? They have sold because now they will buy it from the publisher, and then that those books will be delivered to you. That means what are they doing first in this business? They are selling first. Okay, that means they are taking the order. They are selling first, and then they are buying it from the manufacturer or publisher. So there are a lot of businesses where selling is happening first and then buying is happening second. That you have to understand in the business. Okay. Another example could be just like think you are a marketing person, so you are going to your friend and you are saying like, look, there is a new phone in the market whose price is like maybe 50,000, and you are telling all the characteristics, and then your friend is saying like, okay, fine, I'm ready to buy this mobile, I'm ready to give you 50,000 rupees, but you might not even have any phone with you. So what will you do? You will just go to the market, and you will buy it for 45,000. You will take 5,000 and you will give phone to your friend. That means what are you doing here? You are selling it for 50,000 and then you are buying it for 45,000. So this is how you are making profit of 5,000 here. Okay. Similarly, another simple, just I'm giving you some ground level simple example, very layman's example. Another example, just imagine like you are subscribing for newspaper. When you are subscribing for newspaper, what are you doing? You have paid entire year's subscription amount. But then does that mean like newspaper vendor has given you all the newspaper? No. Now each day he is going to sell. Just one minute. Okay, 1 minute. Yeah. So um, so here, does that mean the newspaper vendor has sold all? No. Now he will keep giving you the newspaper. So what has he done? He sold the subscription first. Now he will get the news and give it to you. So what are they doing now? In all this business where they are taking advance payment. Advance payment is equal to what? Selling. They are selling first and then they are buying next. Okay, you got the idea? This is what is happening in the business world. Now coming to share market. Now in share market, what happens? Let's say you are buying for 100, and then when the price goes to 130, you will sell. Then that means, so what is happening first? You are buying first, and then you are selling it for 130. Okay. So this is a normal business, normal deal where an investor or trader is making money. But there is another way to make money here. What is that another way? Another way is, uh, imagine you believe that the price will go down. Right now the price is 100, and right now the price is 100, and you believe that the price will go down. Just imagine, like you are one day, one fine morning, you are getting up and you are switching on the you are switching on the TV news channel, and you get to know a news that some any big businessman you can think, and that businessman is being rushed to the hospital. So what will happen to his company's shares? What are you predicting? Imagine company x's owner, there is a news that he is being rushed to the hospital. What do you think will be the share price of that company x? It will go up or down? What do you think? Hello?
It will go down.
It will go down. Yeah, so that is your prediction, that it will go down. So but then mind you, you don't have this company shares. So now when you don't have this company's shares, so but then you have predicted that the price will come down. So what you can do over here, you will enter as a seller, and here there is a buyer. So there is a commitment over here. So you are entering into a commitment to sell shares to the buyer. But mind you, you don't have any shares. Okay, but the system can still allow you to sell. If the broker is allowing you, then the system will allow you to do short selling. So in this one, you are selling shares without having the ownership of the underlying asset. You are selling shares without having the ownership of the underlying assets. Okay, now when you sell, and then imagine you are going back to sleep now. Okay, so when you're going back to sleep, and then after 2 o'clock, this happened at 10 a.m. Imagine now at 2 p.m. uh, and at 2 p.m. you are getting up and you are getting up, and what you notice is that the price has come down to 70 rupees. Now when the price has come down to 70 rupees, now what will you do? You will buy. Now when you buy, so what will happen when you are buying? uh, that means you will get shares from another seller. You will get shares. Okay, those shares will be routed to this guy. So that means he is happy. So now net what have you done today? Net you sold initially for 100 and later at 2 p.m. you bought it for 70. In other words, I can say you bought it for 70 and sold it for 100. That means in between you made a profit of 30 rupees. That too when the underlying asset was falling down. Have you understood this one? This is called short selling. Short selling means where you are selling first without owning the shares and later on you are buying. Is it okay? Clear?
Yes, sir.
Yeah. Now this is short selling. Now case, let me give you the broader case. Now imagine you are getting up at 2 p.m. and what you notice is that morning the news that you saw, let's say that was Mukesh Ambani, and that he was rushed to the hospital, and then you sold Reliance shares. Okay, that was the case. Now at 2 p.m., case 2, when you are getting up and switching on the TV, you get to know that that was a fake news, and Mukesh Ambani is practicing in his terrace, jumping around, and he's practicing for marathon race. So now looking at that, what happened? The share price went up. Now the share price went up to 130 rupees. Now what will you do? Now what will you do? One way is that there is a commitment for you, right? You have already sold shares. There is a commitment to give shares. So what you will do is you will buy it for 130 and you will make a loss of what? 30 rupees, because you are buying for 130 and you are selling for 100. It will go like this. So you have made a loss of 30 rupees. Okay, so you have made a loss of 30. Okay, you have made a loss of 30 rupees. This is one possibility. What are the other possibilities? Other possibilities. Okay, so you take losses, you book losses and finish the deal. Okay, that is also fine. But what if you think that no, now it has gone to 130, I will wait for 1 week, because next week I know Reliance is going to declare results and result is going to be bad only. So next week I'm expecting it to come down. That is your prediction. So what to do? But here already there is a commitment. Already there is a commitment to pay amount to this guy. So when already there is a commitment, what to do now? Because now you are thinking that it will come down, but when? Next week. So what will you do at this time? Now here comes custodian. Last time also I was speaking about this custodian. So custodian means what? Now they are doing the work of safeguarding investors' financial assets, right? So they are safeguarding investors' financial assets. So there are many investors, okay, whose assets are held by the custodian. Now these are all long-term investors. Imagine now he is a long-term investor. So long-term investor means what? He will buy and then he will forget, because he doesn't require only. He doesn't need to do anything with those shares. Like, for example, imagine there is a person in India who bought, like, 5 6 big homes, and then suddenly he is going to US and settling there. Then what to do with these homes? What will you do? He will catch hold of one broker, and then he will give the task to him that you give it on rental basis to other people, and then you also take some commission and give the remaining amount to me. Similarly, these shares, are there on long term basis. They are not doing anything now. So what they will do is they will have tie up with the custodian, that if somebody needs my shares, for on temporary basis, lend those shares to them. Lend those shares to them means what? It's like borrowing and lending is happening. Okay, you lend those shares to them, it's fine. So what will happen? this short seller will approach the custodian, and he will say like he wants to borrow shares, just like how we borrow cash. Similarly, shares also can be borrowed. So he will borrow this guy's shares, and this shares will be, you know, sent to the this short seller, and through him it will be sent to the buyer. That means now buyer is happy. Buyer is out of the system now. He got the shares. But now the short seller is answerable to this custodian. Okay. But anyways, it's a deal. So what will happen now? They will wait for one more week. Now next week, when the share price comes down, assuming it goes as per his plan, then in that case, what will happen? He will he will buy it in the market at 70 rupees, and that shares he will give it to the custodian. Okay, and then that will be passed on to the investor. So basically this concept is called as securities lending and borrowing. Securities lending and borrowing. Securities lending and borrowing. Securities lending and borrowing, or securities borrowing and lending. Okay, so this is the concept. So that means it is just like this. See, there is A, there is B. A is the borrower, and A is supposed to lend money. A is the borrower and B is the lender. Imagine now, borrower is supposed to pay back to this lender, but he doesn't have cash. So how will he manage? He goes to P. So he will again borrow from uh, P. That money he will give it to B. Okay, and later stage he will pay to P. Right? This is how it will be managed. Same way it is getting managed over here. This is called securities lending and borrowing. Have you understood this concept, securities lending and borrowing?
Yes, sir.
Yeah. Okay. Subhajit, you have understood this one?
Yes, sir.
Okay.
Clear.
Okay. Securities lending and borrowing. Okay. Then, uh, yeah. Then here, payment in lieu. Payment in lieu means short seller must pay all dividends or interest that the lender would have received from the security that has been loaned to the short seller. That means now, as I said, 1 week. So 1 week, this shares, will be sent to the buyer. Okay. Now during this time, imagine if company is announcing some dividends or paying some dividends. So that dividend will be paid to the buyer only. But then the short seller will take the onus. He will have to pay all such things to the custodian, and that will be routed to the investor, so that this investor is not in losses. Okay, that is called payment in lieu. Payment in lieu. Okay, that means during the time of uh, this short selling and securities borrowing and lending, whatever interest or dividends has been paid to the underlying asset, that has to be, paid by the short seller to the custodian. That means to the end uh, long-term investor. Okay, that is called payment in lieu. Okay, yeah. Then the broker earns some interest on these funds and may return a portion of this interest to the short seller uh, at a rate returned to as the short rebate rate. The short seller must also deposit the proceeds of the short seller's collateral to guarantee the eventual purchase of security. The broker that then earns interest on these funds and may return a portion of this interest to the short seller at a rebate as the short rebate rate. I think this is not required. Yeah. Basically, what it means is when he is doing short selling, he has to keep collateral. Okay, fine. Then leveraged position. Yeah. So now, what do you mean by leveraged position? So just go through this question and then I'll explain this leveraged. Yeah. So leveraged ratio. What do you mean by leverage ratio? Leverage ratio means uh, it is also margin trading. Margin trading means what? Margin trading means as an investor, you are not giving all money to buy shares. Say, for example, 100 rupees is the price of the share. 100 rupees is the price of this share. 100 rupees is the price of the share. And imagine you are paying only 40 rupees. When you are paying only 40 rupees, that is called as initial margin. Initial margin. So that means what you pay, you think like advance payment, that you are paying is only 40 rupees. So with 40 rupees, you are getting exposure to the product worth 100 rupees. With 40 rupees, you are getting exposure to the product worth 100 rupees. Okay. Yeah. Now, such kind of trading is also called as margin trading. Okay. Margin. That margin means partial payment here. So only partial payment you have done and you are able to trade. That means rest of the amount. So sorry, how is it possible? How it is possible is rest of the amount you are borrowing. Okay, rest of the amount borrowing. So broker will be paying to you. Okay, rest of the amount broker is paying to you. Okay. Mhm. So here, so this is margin trading, which is also called as leveraged position or leveraged position. Leverage means margin. Okay, leveraged position or trading on margin. Now coming to this question, see here, shares purchased. Okay, or basically what do we understand with the leverage ratio? Like in this case, see, leverage ratio's formula is 1 by initial margin. What does this mean? Like in this case, 40 rupees is paying, that means 40 percentage. So here 40 percentage. So 1 divided by zero point 0.4 is how much? 1 divided by zero point 0.4 comes to 1 divided by zero point 0.4 is 2.5.
2.5.
So what does this mean, 2.5? What does this indicate? What it indicates is with 40 rupees, I will get 100 rupees product, or with zero point 0.4, I will get 1 rupee product. Okay, with 0.4, I will get access to 1 rupee product. So if I have 1 rupee, I can enter into a product worth 2.5 rupees. That is called leverage ratio. That means with 1 rupee, what worth of product I can get exposure to. Okay. With 1 rupee, what worth of product I can get exposure to. Okay. This is called leverage ratio. You understood the meaning of leverage ratio? That means with 1 rupee, I will get exposure to 2.5 rupees product. That means if 100 rupees I have, I can get exposure to 250 rupees. Okay, with 100 rupees, I can get exposure to 250 rupees. Okay, that is leverage ratio. Now coming to this question, see this one. Shares purchase 1000, purchase price per share is 100. Annual dividend per share is 2. Initial margin requirement is 40 percentage. Call money rate is 4 percentage. Call money rate means the interest rate that you will pay on borrowing, because we are borrowing the remaining amount, right? In this case, 150 rupees we are borrowing, 100 only is ours. Remaining 150 is paid by the broker. So that is borrowing. The interest that you pay on this borrowed amount is called as call money rate. Okay. Then commission per share is 0.05. So when they say commission per share, they are not clearly saying whether it is for buy or sell. That means it is for both buy also as well as for sell also. We are paying $0.05 per share. Stock price after 1 year it reaches to 110. Calculate leverage ratio, investors return on margin, transactions if the stock is sold at the end of 1 year. Okay. See, uh, so first of all, leverage ratio is equal to 1 by initial margin. So what is the leverage ratio here? 40 percentage. Acha, this is also 40 percentage only. So 40 percentage, that is equal to 2.5. So that is the leverage ratio, 2.5. So that is done. Next question is investors return on the margin transaction. If the stock is sold at the end of 1 year, investors return on the margin transaction. Okay, so what is the return? Okay, see, let's say this is buy. When you are buying and when you are selling, what is happening? So when you are buying, first of all, shares purchased 1,000 shares, price per share 100. So total price of the share is equal to 1,000 shares into 100. That is equal to 1 lakh. Now 1 lakh is the total price. But did we pay 1 lakh? No, we paid only 40 percentage. So cash outflows for buying is 40 percentage of 1 lakh. That comes to 40,000. This is the amount we have paid. Plus what else did we pay? We paid commission of $0.05 per share. So commission 0.05 per share, 0.05. So 0.05 per share commission. How many shares bought? 1,000 shares. So into 1,000. So that comes to 50. So overall, this is the cash outflow. Total cash outflow. Invested amount. Amount invested. Okay. So amount invested 40,050. Then what happens here in sell? In sell, now we are selling after 1 year. So when we sell after 1 year, so at the time of selling, what is the price? Price is 110. So sale value is equal to 110 into 1,000 shares. That is equal to this much money the buyer must have got it. But can he take all money to his home? No, because he has to repay the debt first of all. So repay borrowed money. How much did he borrow for? He has borrowed for 60,000, because 40,000 is own money, initial margin. So remaining 60,000 he has borrowed. He has to pay back 60,000, and he has to pay interest on that, which is called as call money. Call money rate. That is how much? 4 percentage. So 4 percentage of 60,000. That comes to 2,400. Okay. Then anything else here? Uh, yeah, we also receive dividend, annual dividend per share. So that is a plus point. Annual dividend per share. Annual dividend per share is 2. So 2 into 1000. So 2000 is the positive number. Okay. Then commission. We have paid commission also. Commission is what? Again, same this way. 0.05 per share into 1000. That is equal to 50. So this is also cash outflow, right? So dividend we have included, all informations we have included. So we received 1 lakh 10, but all this plus 2000 also we received, but we paid 60,000, 2,450. So net how much cash will we be left out with? Just calculate all this.
It's 49,550. It's 49,550.
Okay, 49,550.
Yes.
Okay, so that means you entered with 40,050. You invested 40,050 and you got 49,550. Okay, you entered with 40,050 and you got 49,550. Okay, so that means so returns, so investors return is equal to what? It is equal to 49,550 divided by 40,050 minus 1. You can calculate like this. Just calculate how much it comes to. This is your return.
It's 23.72%.
Okay, 23.72.
Yes.
You can calculate like this, or you can take these differences. Take the differences. Let me check if it is right. 23.72. Yeah, perfect. Just take the
Just a minute, I'll
differences.
copy.
Huh. Take the differences.
That will be 49,550.
9,500, correct?
9,500.
9,500 divided by 40,050 into 100. You will get,
40,050 into 100. Yeah, it's the same.
yeah,
That's it.
yeah. So, uh, I'm not sure if you are writing or not. Anyways, it is getting recorded later on also. You may see it. But
Yeah,
if you are
like
writing also,
uh,
if you want me to like pause, you let me know.
yeah, just 2 minutes. I'm
Okay.
writing.
Yeah.
And so
Yeah. Okay. Yeah. So next one, you will find such kind of questions. Okay, in the website also. Then next one, maintenance margin or margin call. Okay, now what do you mean by margin call? Margin call means, now imagine here 2.5, so 2.5 was leverage ratio. So here 40 percentage. So if it is 100, you are paying only 40 rupees. If you are paying 40 rupees, now the question is, then remaining 60 is, is paid by the broker. If broker is paying remaining 60, then broker, uh, when he's paying remaining 60, uh, broker would like to play safe as well, right? So, so what does it mean when I say he would like to play safe? That means, imagine if the price is coming down. Okay, if the price is coming down by, let's say it has come down, imagine it has come down by 30. That means even here this value will come down by 30, so it will come to 10. Okay, so that means your investment is only 10 rupees now. Okay, and because your investment is only 10 rupees, okay, and uh, yeah, your investment is only 10 rupees. So now the broker will get tensed. Okay, why broker will get tensed? What if this, if it comes down further? Imagine 20 rupees, it comes down further 20. That means 100 has become 50. But your investment is only 40 rupees. So remaining 10 now, that means you are losing all 50. Imagine. Okay, now imagine now you are losing all 50. But out of that 50, 40 only is yours. So remaining 10 rupees, who is losing now? The broker is losing, and the broker would never like to lose that amount. So what he will do, when the price is coming down, okay, like here 140, when the price is coming down to something like 80, and here it is coming to something like 20, that means your money is still there. See here, 20 rupees down, here also 20 rupees down, your money is still there. So he wants to get back, you know his money uh, as soon as possible. That means what will be the limit? Okay, what will be the limit that at which he will give a call to the broker and say, look, I cannot take more risk, you please invest more money and bring it to the initial margin. That means, see, now there is a, let's say this is the sum. An investor purchases stock for $40 per share with an initial margin requirement of 50 percentage and the maintenance margin requirement of 25 percentage. At what price will the investor get a margin call? The formula is margin call price is equal to P0, that means current price, into 1 minus initial margin divided by 1 minus maintenance margin. Minimum maintenance margin means minimum maintenance. Minimum some maintenance will be there. Like for example, here if it is 20, so the moment it touches 20, then the broker will not take further risk. He will ask the investor to invest and bring the margin up. Okay, let's see this one how it works. See, uh, share price is 40 per share now. 40. Initial margin is 50 percentage. divided by 1 minus maintenance margin is 25 percentage. Just calculate this. That means minimum 25 percentage has to be there. Just calculate.
26.67.
So that means, so in this case, how it works, right now the price is 40 and initial margin is 50 percentage. That means you will pay only 20 rupees. Remaining 20 is given by the broker. And the moment the price comes to 26.67, okay, that means here also it will come down by, so what is this difference? 40 minus 26.67, how much? 40 minus 26.67,
13.33.
Yeah, 13.33.
13.33. So the moment here also, if it comes down by 13.33, so 20 minus 13.33 is what?
20 minus 13.33 is 6.67.
6.67. Yeah,
Yes.
so when the stock price comes to 26.67, here also it comes to 6.67. And now the broker will not wait any longer. He will ask the investor to invest and bring the margin up. Suppose if the broker does not agree, then suppose if the investor does not agree, then what will happen? See, still these are all investors' money only, correct? This is traders' money. So broker's loss has not yet started. Okay, broker's loss has not yet started. All these are whose loss? 13.33. Traders' loss only. So the situation is still in control of the broker. If the trader does not agree, he will sell these investments and uh, and take from the 6.67. He will take his interest charges and all, and pay remaining to the investor. You understood how he is safeguarding himself through this example?
Also, can you explain it once again?
Yeah. So okay. So I'll give this example again. See, what it means is, yeah, what it means is, right now 40, and you are the trader. You paid how much? 20,
20.
and broker is paying 20.
Yeah.
Now the price has come down by 13.3 rupees. That means it has come to 26.67. If this
Okay, the
has come down,
26.67 is the new price.
is the price. Yeah. Now here
Okay.
that means you lost 13.33. So here also in your margin also you will lose 13.33,
Yeah.
and it will come to 6.67. So you
Yeah.
have only lost your money. Broker's money is still intact
Okay.
because he just helped you to get exposure. Okay,
Okay.
so he helped you to enter into the trade. But who is supposed to bear all these losses? 13.33. You will be bearing all these losses,
Yeah.
but instead, just imagine this 40 has come down to, assume for a minute, you invested 20, broker invested 20. Assume for a minute it has come to 10 rupees. That means 30 is lost.
Yes.
So in this case, your 20 you have lost, it will come to zero. He has lost his 10 rupees
Yeah.
because this 20 is gone and this 10 is also gone.
Yeah.
But the broker, so that means the broker will play safe. His money should never go.
Okay.
So that's why he will not wait for this 40 to come down to 10. He will not wait for this 40 to come down to 10. You understood over here? Because now see, now investor trader has lost all. Now 10 rupees broker has lost. Now if the broker asks the trader, will he give? He will say, I don't care only. Why should I pay? I don't care. I have lost the money. I'm going. That's it. So now the broker will also suffer. Is it
Yeah.
okay?
Yes.
The broker will also suffer, right? So that's why broker is playing safe. That here itself, when it comes down to 26.67,
Hmm.
he will immediately call the
And the call
trader
amount would be
and
13.3
ask
rupees.
him to pay money and bring it to initial margin. He will
So
say
it will
pay
be
more money.
13.3 or 6. It will be 6.67, right? When the price is at 26.6.
6.67, his money is still there. Still there. So that's why now itself, broker will catch hold of him.
No, so the money, the additional money that he has to pay is 6.67, right?
No,
Or
no,
13.
6.67 is his money. It is already there.
Okay.
He has to pay more money and bring it to initial margin. That means 20. So
Okay.
remaining 13 rupees
26.67 plus 13.33,
plus
like
that
back to 40.
that 13.3 rupees that he has lost, he has to pay back again and bring it up to initial margin. That is 20 rupees. Hello.
Yeah, yes, sir.
Yeah. Is this okay now? You are able to understand this?
Yes, yes.
Okay. Shravan, you understood this?
Yes, sir.
Okay. See, I'll give you another example also, layman's example to similar analogy. Just imagine you are taking a home on rental basis, and the owner says, give me 6 months advance. Why? Why is he not taking only 1 month's advance? Or why? What if he doesn't take only advance?
Like he's playing safe. You may not pay, like the tenant tenant may not pay like after staying there.
Huh. See, basically, you paid only 6 months. Why is he taking 6 months advance? Because if you do not pay 1 month, see, it is like this one only. Now you are paying, imagine, let's say 6 months, 10,000 is the rent, monthly rent. So 60,000 you paid. By paying 60,000, you are getting a home worth maybe like 50 lakhs.
Yes.
So 50 lakhs product you are getting exposed to just by paying 60,000. Now, so the owner is helping you to get this product, but then he also wants to have control on the situation. How will he have control on the situation? That suppose your job is to pay him rent every month. Let's say first month you did not pay. Okay, fine, genuine reason. He thought like first month is okay. One time it happened. Then second month, no, imagine second month COVID came, so he understood that it's okay. Third month you fell sick. Now fourth month, what will he do? He will become alert. He will think that okay, this guy is very suspicious. It doesn't look like he wants to pay. So is he at loss if he is waking up, in the fourth month? Is he at loss?
Uh,
Fourth month if he is
the
waking up, huh?
tenant or the owner?
The owner. Tenant is
No,
like
he's still
staying
not
in.
at loss.
Yeah. Why? Because even though he helped him to get the exposure of 50 lakhs, the owner still is not at loss. Why? Because fourth month, what will he do? He will deduct all 40,000, ten
Yeah.
thousand, 10,000 four times, and then he will pay remaining 20,000 to the this tenant, and then he will say move away. So the
Right.
situation is still in the control of the owner. Situation is still in the control of the owner. Is it okay?
Yes.
What if, imagine, if the tenant seventh month also doesn't pay? Now who is in whose control? Now the owner has lost all the control. Now why will the tenant pay now? Already 7 months he did not pay. Now Now the owner has completely lost the control. The tenant is controlling the owner now, because whatever tenant says, the owner has to agree only now. So he will not like to go to that extent. So before that itself, he will become alert. That means fourth month only. Similarly, here also, once the price comes down by 13.3 rupees, the broker becomes alert here. Is it okay now? It's fine.
Yes.
Okay. Yeah. So this module quiz later on, you please read first all, and then you try it. Okay. And then you let me know whatever you don't understand. You let me know. Okay. Then uh, yeah, order execution and validity. Okay. Now this is a very important page. Okay. Order execution and validity. Very important one. Um, yeah. So bid price, ask price, and then bid ask spread. See, say for example, bid price means what? Bid price means the price at which buyers are ready to buy. Say for example, 100. Okay, 100, and so this is the bid price. So if you see in nseindia.com also, you will get to see the top 5 bid price. Let's say 100. So he is the best bidder. So best bidder means what? The one who is quoting the highest price. And then imagine it is 99.50, then 99, then 98.80, and then 98.60. Okay, this is the bid price. Offer price. Offer prices. Imagine offer means what? Ask. Offer price is also called as ask price. Offer price means seller's price. The seller, the price at which seller is ready to sell. So the best seller will sell at what? Higher price or lower price? The best seller will sell it at the lowest price. Okay, if he is highly interested in selling, he will sell at the lower price. So lower prices, let's say 101. So he is asking 101. Okay, so 101. Uh, yeah, 101. Then 102. Then 102.30. Then 102.50 and 102.80. This is the seller's price. Now this difference is called as bid ask spread. Spread difference is what? Difference is 1 rupee. So that 1 rupee is the bid ask spread. Okay, bid ask spread. So bid ask spread is the difference between bid and offer or ask price. Size means quantity. So let's say here quantity, he wanted to buy 2 shares, here 25 shares, here 10 shares, here 1000 shares, and here 700 shares. Okay, and here he wanted to sell quantity. Quantity also called size. Okay, size or quantity. This is 8, 12, 300, 400, 7,000. Okay, but for us quantity doesn't matter now, it is the price that matters. So here some of the keywords that you should know is uh, yeah, make a new market, then take the market, And then,
Okay.
yeah, execution instructions that specify how to trade, validity instruction that specify when to trade. Okay. So what does this mean now? See, make a market. Traders who post bids and offers are said to make a market. So they are making a market. Okay, the trader who posts bid and offers are said to make a market. So they are making a market here. These terms are needed. Okay. While those who trade with them at posted price are said to take the market. So that means tomorrow, or imagine in this case, now a new buyer comes and if he says, fine, I am ready to buy at 101. Okay, he is posting the price 101. So now the deal will take place. This is called as what? Take the market.
Good.
Take the market. Okay. Then, if you don't get anything, feel free to stop me then and there. Okay.
Yes.
Yeah. Yeah. Take the market, make the market is over. Then the order can also include execution instruction that specify how to trade. Okay. How to trade, execution instructions. Yeah. So here it is, execution instruction, limit order, and uh, okay, here under this you have limit order, and then market order. Okay. So all these are execution instructions. So under execution, limit order, market order, all or nothing, hidden orders, standing limit orders. We'll discuss all this one by one. Limit order and market order. These are quite known one. What do you mean by market order now? So execution order, execution instructions. Okay. Under that, market order. So market order is it's like you are going to the shop and you are saying, look, shopkeeper, I want that particular shirt. So shopkeeper is giving you the shirt. Yeah, Subhajit, are you talking something?
No, sir.
No, no. Okay. So Mark, so you are going to the shop and you are saying, give me that particular shirt. Now the shopkeeper is giving you the shirt. Then you are saying, what is the price? Shopkeeper says 1,000 rupees. You are giving the price and you are taking the product and going to your home. That is market order. That means you have already decided to buy. You are just going to the market and you are saying like, what is the price? So when you are placing the deal, when you buy and sell, practically when you buy and sell, you will come across to this term. So it will be mentioned in the system, market order. Okay. Now when you click on this market order drop down box, now this price will get grayed out. This is where you are supposed to key in price. It will get grayed out. Why so it will get grayed out? Because uh, now this, what it means is you are telling to the system that system, whatever is the best price in the market, go and search. Whatever is the best price in the market, I want to buy. I have already decided to buy Reliance. So that is called market order. Okay. Market order. Yeah. Now then the other one is limit order. Now what is limit order? Limit order means there are another type of people who will go to the shop and then they will say, show me that shirt. Then what is the price? Then the shopkeeper will say 1,000. Then the this customer will say no, to me at 500. Then the shopkeeper will say no, 900. Then the customer will say no, 600. Then the shopkeeper will say 800. Then the customer will say 700. That means they are putting limit that I will not buy above this price. That means here you will select limit order. When you select limit order, then the system will ask at what price you want to buy. So you are free to quote the price. Say for example, here somebody is, you want to buy shares. Imagine somebody is quoting 111, 101. You might put 100.5. If this guy is reducing to 100.5 or anybody coming to 100.5, then only I will buy, otherwise not. So till your order gets executed, it will be there in the queue in the system. And the moment any seller quotes 100.5, it will get executed. That is called limit order. Market order and limit order. Okay, market order and limit order. Okay, then here some other keywords. A limit buy order. Yeah, a limit buy order above the best ask. Above the best ask. Above the best ask. That means, imagine if instead of saying 100 and 100.5, if I say 102. So if I say 102, then quite possible that this deal will take place. This two deal will take place. So that's what it means. A limit buy order above the best ask, or a limit sell order below the best bid. Below the best, either this price, or else imagine somebody is selling. So a seller quotes 100. So then also this deal will take place. Okay. So a limit sell order below the best bid. So this is below the best bid. See 101 below the best bid. Okay. Or a limit buy order above the best ask are said to be marketable or aggressively priced. That means which are better than the best bid and ask. Then that is called as marketable or aggressively priced, because at least part of the order is likely to execute immediately. Okay. If the limit price is between the best bid and best ask, a limit order is said to be making a new market. Okay, that means if this is 100 and 101, I'm just rewriting here because this is looking too dirty now. So if somebody is quoting the price as 100.5 and here 100.8, this is called as making a new market, because these prices are better than the previous one, correct? Better than the best one. Then it is called as making a new market or inside the market. Making a new market or inside the market. Limit orders waiting to execute are called standing limit orders. All these are standing limit orders. These are all waiting to be executed. Standing limit orders. Okay, standing limit orders.
So just a minute, I'll copy.
Huh?
Can you wait for a minute? Like I'll copy, I'll note it down.
Once again, which one?
Like I'll note it down. So could you please
Acha,
wait
acha, you
for a
want?
minute? Yeah.
Okay, okay, okay. Yeah, yeah. Yeah.
Done, sir.
Yeah. Okay. Huh. Then all or nothing. Acha. Significantly higher than the best ask is said to be far from the market. The limit by order. Uh, acha, there are other words also behind the market. So you buy order with your limit price below the best bid, or sell order with your limit price above the best ask is said to be behind the market. So these are also standing limit orders, and these are also called as behind the market. And behind the market, they are behind the market. Okay. And order with your price significantly higher than the best bid is said to be far from the market. Best ask. So all this far from the market, like this part, all these are what? Far from the market. Okay. Far from the market.
Yes, sir.
Then, so you can just uh, key later on when you read, frame notes. Okay. That this is far from the market. This kind of words you just write it down separately, and the keywords associated to it, because one or two questions are highly possible to come from this page. In fact, if you practically trade, it will be more, it will be easier for you to correlate all these things. Okay. Then uh, yeah, so far from the market. So then next one. Okay, fine, I'll just repeat all this, okay, to be on the safer side. See, this is 100 and this is 101. This difference is called bid ask spread. And then whatever other price, let me take the same one so that there is no confusion. 99.50, then 99, then 98.80, then 98.60, 102, 102.30, 102.50, 102.80. Now these are all called what? These are all, this last price, these are all behind the, far behind the market, right? Far from the market. So far from the market. The keyword is significantly higher than the best ask. Far from the market. That means what? Significantly higher.
Yes.
Significantly higher than the uh, best ask. Okay. This one is making the market. That means the best one. is called making the
Okay.
market. And if you put more aggressive, if you go more aggressive, like here somebody quoting 101 and deal will take place.
Take the market.
Okay, yeah, or this is 100, okay, and this deal will take place. Then it is take the market, right? Uh, yeah, where is it going to take the market?
It is in the professor's note.
Take the market,
Yeah, the first para. Okay, first para in the professor's note, sir.
professor's note.
Yeah,
Where is professor's note?
like it's above execution instructions.
Acha, it is here. Okay,
Yeah, yeah.
okay.
The
Take the
second
market.
second
Yeah,
para.
yeah. Okay, make the market, take the market. Yeah. Trade with them as posted price. Those who trade with them as posted price is set to take the market. Yeah. Okay. Then, yeah. Then make the market, behind the market. All these are behind the market. Okay, these are behind the market. Then, yeah, this is it, right? And if you quote in between,
Yeah.
in between price, in between means something like 105 and here 100 and 100.8, 100.50, 100.80. This is called inside the market or
So
making a new market. Where is it? Ah, making a new market or inside the market or inside the market. Okay. Yeah. Okay. Till here, fine, right? Then all or nothing. All or nothing means what? That you are placing deals where you are saying you want all, only if whole order can be fulfilled. Okay, that means if you are buying, it's like you are going to a shop and you are saying, I want to buy 5 shirts. If you have 5 shirts, then only I will buy. I will not buy one shirt. Okay, so you want to buy all, or you don't want to buy even one. So all 1,000 shares I want to buy, or I don't want to buy anything. Then that is called all or nothing orders. Then hidden order. Hidden order means what? Now imagine somebody is placing deal for a very large number of shares, 10 lakh shares. See here, total, if I add up all this, okay, if I add up all this, it will come to, like normally, maybe imagine overall, if I add all this quantity, that quantity, imagine quantity is mentioned here. It may come to like, 1 lakh people want to buy, 1 lakh shares they are interested to buy, and maybe 1 lakh 40,000 they are interested to sell. But imagine suddenly somebody comes and says, I want to buy for 10 lakh shares. If somebody, places a deal for 10 lakh shares, then just imagine this 1 lakh will become 11 lakh now. And here on the other side, 1 lakh 40. When somebody is buying for such a huge number, and if that is displayed here, will anybody even sell first of all? Correct?
No.
Nobody will be interested to sell also. Why? Because they will think that, oh, something good is happening with the company. So whoever is selling, they will stop selling. So that will create what? Liquidity problem. Nobody will sell them. Also, imagine vice versa. Somebody who is selling for 10 lakh, just imagine now it becomes 11 lakh 40 and here 1 lakh. So everybody, they will think that, something wrong is happening within the company and that's why everybody is selling. So nobody will buy them. So this will create liquidity problem. So these investors who are doing big deals, these institutional investors, what they will do, they will use hidden order. Okay, hidden order. So hidden order means what? Hidden order means it's like it is also called iceberg order. Okay, iceberg order means it's like this iceberg. Only this will be visible. That means they will mention only 10,000 and remaining 10 lakhs will be here. It will not be visible in the system. So this 1 lakh will become only 1 lakh 10,000. 1 lakh 1 lakh 10,000. 1 lakh will become 1 lakh 10,000. Okay, that is called iceberg orders or hidden orders. So such kind of orders also can be executed. Okay, then validity. Okay, so validity means when will the instruction be valid. So you should know what comes under execution instructions. All this comes under execution instruction. Hidden orders, display orders, all or nothing. Okay, this will tell you how it has to be executed. Then validity means when the instruction is valid. Okay, so first one, day order. Day order means what? Now you are saying, you are putting some price. Now this price is valid only for that day. Once that day gets over, automatically it goes out of the queue. Okay, automatically it goes out of the queue. That is called day order. And the opposite one is good till cancel. That means it will be there till it is cancelled. That means next day also that order will be there in the queue till somebody is ready to, you are ready to sell at 102.80. Till somebody is ready to buy at 102.80, it will be there only forever. That is called good till cancel. Okay, good till cancel. Immediate or cancel. Immediate means immediately orders are unless they can be filled immediately. That means immediately I want, or else cancel it. I don't want anything. I don't want my instructions to be in queue. Either I want to, so it's like you are going to the shop and you are saying immediately give me the food. I don't want to wait. Either I want the food immediately or I don't want to have only. So that way, which is also called fill or kill. Then good on close. Good on close means closing price 330, closing price. That price at that time only you want to buy. So whatever be the closing price, at that price you want to buy. Then good on open. That means opening is what? 9:15 a.m. when the market opens. That price you want to buy it. That is good on open. Okay, good on close, good on open. Okay, fine till here. Any questions, Shravani? Have you understood all this?
Yes, sir.
Okay, okay, fine. Then next one is stop loss. Okay, I will, see if required, I don't mind repeating all this next time. The only request is like you read this from your side and then you come up with your doubts, questions, then only it will make more sense. Okay, and then I will repeat. Whatever I have to repeat, do not hesitate to ask me. I have no problem in repeating. You have to get convinced. Okay, that is more important. So if you are not convinced anywhere, you are always welcome to tell me that. Okay, now stop loss means what? Now we'll keep this as the last one for today. Okay, once I finish this stop loss, then we will stop here. Okay, stop loss means you are stopping losses. Now how will you stopping losses? Stop loss means, see here, stop stop buy is also there. Stop buy. This we need to learn. Yeah, stop buy and stop loss. Okay, stop loss means what? Imagine, for example, you have already bought at 100 rupees. When you already when you have already bought at 100 rupees, you have bought. Now your worry is you have already bought. Okay, your worry is what if the price comes down? So you already bought long back, and now the price is going on at 100. You know that once the price reaches to 90, it will come down highly. So at this price you want to sell, so you will put stop loss, stop my loss as at 90. Okay, stop loss. So uh, and then okay, this is stop loss. There was one more word, stop loss. Is there limit stop loss? Okay, this is stop loss. Now what is stop buy? A stop buy order is entered with a stop trigger above the current market price. Stop buy order. A trader with a short position could attempt to limit losses from an increasing stock price with a stop buy order. Uh, okay. Okay. Stop buy means what here? Simple. Imagine you are, see, this one is normal. You bought and you don't want to suffer losses below 90. Now imagine you have done short selling. Now, if you have done short selling, you have to buy also, right? You have done short selling. You have done short selling. Now your worry is if the price goes to if the price goes to okay, uh, if the price goes to 110, you know that beyond this you don't want to take losses, so you will put stop buy order. That means automatically when it reaches to 110, the system will buy, so that your loss doesn't go beyond 10 percentage here. That is called stop buy order. Okay, understood this one, stop loss and stop buy?
Yes.
Yes, sir.
Yeah. Okay, I think then that's it. Okay, you just read this, let's see if you can understand this. Is it okay till here? Stop loss and stop buy. Okay.
Yes, sir.
Yeah. So we will
Yes.
stop now here. And then you read all this very carefully. This is a very important page that we have done. And then you tell me again whatever, wherever you have doubts, not convinced anywhere. Uh, Anyways, this is all, this record also, I will send it to you now. You watch that as well. And then again, you let me know wherever you have doubts. We will repeat that, okay? Because I don't mind repeating this again. As I said, it's a very important page, whatever we have done today. Okay, fine. We'll stop now here.
Yes, sir.
Okay, okay, bye.
Bye, sir. Thank
Bye,
you.
bye.